Welcome, ladies and gentlemen, from me, Guy Monson, to our regular Saracen 6-minute strategy on a rainy Friday morning. My title this week is COVID and the Markets, a review of Q3 and an outlook to Q4. The key feature, of course, has been rising infection rates and the worrying news this morning that the President of the United States and the First Lady have both contracted the virus. Continuing upticks in Europe, although France and Spain are a little better, UK rising, worryingly in New York, some of the worst rates we've seen since May, so this is a global phenomenon. By contrast, financial markets have been remarkably stable. Global equities are up again in Q3, volatility a little higher, but this reflects many of the political challenges in Q4. The euro is slightly stronger, but overall the dollar remarkably stable for the year to date. And interesting, there's trends in commodity prices to move upward, with many of the metals and foods actually higher for the year to date continuing. Let's look at this in charts and see some of the implications for asset allocation ahead. Beginning with the infection rates, you can see a little bit of a rollover in those alarming Spanish and French numbers. You can see the UK climbing. Look at the remarkable numbers on China. Almost no infections at all, allowing a much stronger rebound in the underlying economy, possibly allowing positive growth of 1.5 to 2% for 2020, extraordinary numbers. Drilling down to the UK, yes, the blue line, the COVID infection rates COVID cases are rising sharply, but hospitalisation is much lower and positive test rates seem to be lower. So it seems to be higher testing, perhaps more asymptomatic patients, not the pressure on the underlying health systems, thank goodness, that we seen earlier. I think markets were taking comfort from this. What does this mean for overall returns? Well, for the year to date, extraordinary gold still leading in sterling terms with a 26% gain. UK gilts and equity and global equities for a sterling investor about the same, 5 to 7%. Still that huge lag in UK equities. I've just drilled down to the numbers for the quarter. I've done these in local currencies to eliminate that surge in sterling. And it's extraordinary to see global equities up 8% for the quarter ahead of gold, and bond yields almost flat, virtually no move at all in the US 10-year or the UK 10-year gilt. Why is this? Well, of course, central banks continue to be extraordinarily generous, and I've shown the continued expansion of their balance sheets as they buy bonds in the underlying market. In addition to this, of course, we had Chairman Powell's statement after Jackson Hole saying that he would target a higher inflation rate in the short term to compensate for undershoots in the past. This is significant. We've looked at it in previous talks, and I expect it to become gradually a global phenomenon, yet another tool of proactive and extremely generous central banks. This will keep volatility broadly low, although you have seen on that chart on the right some uptick. That's against the political backdrop. Brexit, a possibly contested US election, and worryingly no bipartisan agreement on a rescue package for the UK, for the US consumer and unemployed. So you can see this in chart 6 in currencies on the left. Yes, the euro now the strongest currency for the year to date of the major crosses, reflecting the surprise and excitement, I think, over the European recovery programme. But in general, the move's remarkably modest. Even the pound has rallied sharply to show only a 3% underlying decline against the dollar for the year to date. As I indicated earlier, commodity prices still strong. Indeed, silver, gold, soybean, sugar, cocoa, zinc, even nickel are all up for the year to date, extraordinary against a post-war worst numbers ever seen for the underlying economy. So what does this mean for our outlook in Q4? I'm afraid the stronger summer rebound is going to fade on this worst COVID news and political tensions around the world. It'll be somewhat offset by the Fed policy shift, which I think will become a global phenomenon, adding even more to generous monetary policy. COVID-19 slack, I'm afraid, will be with us for longer than we probably all anticipated. And yes, risks have increased. Tighter stringency measures, political impasse, a contested US election, and of course the Brexit discussions. But interestingly, if we are right in expecting a vaccine sometime in Q4, most of those risks are broadly temporary. They will, in all likelihood, see some mitigation into Q1 and Q2 next year. That's why, against this backdrop, we would probably be adding modestly to global equities on any material sell-off and buying on the dips. Because we expect the fiscal policy to remain generous, that Green New Deal to start to flow into earnings of industrials, and extremely generous underlying monetary policy, which makes equity yields attractive. So still a pragmatic, somewhat cautious approach, but ready to take advantage of falls in the market to accumulate equities modestly further. Thank you.